Today, we're diving into the big news that came out from Moody's right after market close on Friday. So, Moody's cut the US credit rating down one notch, citing the nation's growing 36 trillion debt pile. If you're wondering how this downgrade could affect your investments, open positions, and even the broader economy, you don't want to miss this. Stay tuned as we break down the key implications from higher borrowing costs to potential stock market volatility. Hi, my name's Gautam, and on this channel, I talk about the stock market and achieving financial freedom with the power of options trading. So, if you enjoy content that can help you retire early and achieve financial freedom, don't forget to hit that like button, subscribe to my channel, and share this video with your friends and family if it would help them with their financial journey. And it also helps the channel grow. If you're interested in my free options newsletter, click on the link in the description below to subscribe. Now, let's dive in and get started. First, let's check out this article on CNBC that talks about the Moody's downgrade. Moody's ratings cut the US sovereign credit rating down one notch to AA1 from AAA, the highest possible, citing the growing burden of financing, the federal government's budget deficit, and the rising cost of rolling over existing debt amid high interest rate. This one notch downgrade on a 21 notch rating scale reflects the increase over a decade in government debt and interest payment ratios to levels that are significantly higher than similarly rated sovereigns, the rating agency said in the statement. The decision to lower the U.S. credit profile would be expected at margin to lift the yield that investors demand in order to buy U.S. Treasury debt to reflect more risk and could dampen sentiment toward owning U.S. assets, including the stocks. That said, all the major credit rating agencies continue to give the United States their second highest available rating. With that announcement, the yield on the benchmark 10-year Treasury note climbed 3 points in after-hours trading at 4.48%. The iShares 20-year Treasury bond ETF, a proxy for longer-term debt prices, fell about 1% in after-hours trading, while the SPY that tracks the benchmark index for the top 500 US stocks dropped about 0.4%. So let's simplify all that financial lingo and see what impact the downgrade is going to have on the US economy. So first, a downgrade means higher yields on US treasuries, which means it would increase the US government's cost of borrowing. Second, it could result in a weaker dollar as investor confidence may dip, causing foreign investors to reduce exposure to US assets. As the treasury yields rise, it also impacts other interest rates such as mortgage rates and corporate debts, potentially slowing down growth. Next, let's check out what happened in August 2023 when another rating agency, Fitch, downgraded the US. So for context, Fitch cited the US's growing debt burden and political standoffs as the reasons. Debt to GDP ratio was rising sharply post-COVID. And here's how the market reacted to that downgrade. The S&P 500 dropped almost 2% in the days following the announcement. Bond yields rose modestly, especially on long-term treasuries. Tech stocks and growth sectors dipped as higher yield pressured valuations. However, the market reaction was still muted compared to 2011 as the markets were more prepared for this ratings downgrade. The takeaway from this downgrade was that the investors took it seriously but didn't panic. The safe haven demand for US treasuries still held strong, and markets refocused quickly on the Fed policy and earnings. Next, let's talk about the impact on the US stock market. In the short term, volatility likely rises, especially in sectors sensitive to rates, which could be tech and real estate. Investors may move towards more defensive stocks, such as utilities, consumer staples, and away from growth stocks. Again, with rising interest rates, corporate financials may take a hit with higher funding costs and the risk of tighter credit. In the long term, if the downgrade triggers confidence erosion or signals a long-term financial crisis, it could drag on the overall market sentiment. However, US markets often recover quickly unless a downgrade is tied to a broader crisis. For example, the 2011 saw a downgrade by S&P, but markets eventually rebounded. So for the bottom line, a Moody's downgrade doesn't mean the US will default imminently. It's just a warning about the long-term sustainability and political risk. It could cause short-term trading volatility, especially in rates and risk-sensitive sectors such as tech and real estate, but the US dollar and treasuries still remain globally dominant due to their liquidity and trust, even with the notch lower in the ratings. That's it for today's video. To sum it up, we may see some short-term volatility in the stock market over the next few days, but given the past trends, I believe the markets will come back quickly, especially if we hear more positive news related to the tariffs and international trade deals over the next few weeks. If you enjoyed this video or learned anything useful, please give it a thumbs up, subscribe to my channel, and leave your comments below with any thoughts or feedback. I'll see you in the next one.